Hello value investors, thank you for joining me. Today I want to talk about 3 behavior risks that are stopping you from compounding your portfolio at strong rates of return. If you're new to the channel, don't forget to check out my marketplace on Seeking Alpha. It's called Deep Value Returns. There I'll tell you which stocks I own and why, with balanced arguments for the stocks I own, and you can find out which stocks work out better for you. I have high growth stocks and I look at low growth stocks and I try and value them, and you have a pick. I call it the hybrid portfolio, and you can see what suits you. So with that aside, let's get started. Today we're going to cover 3 different topics. The first topic is about loss aversion. The second one is about commitment and consistency biases. And the third one is going to be about waiting for the right time to invest in a high quality company. So let's get started. So what is quite dangerous in investing is when a person made an investment and after, let's say, 2 years or so, it doesn't seem to be working out, and the investor refuses to sell out at a loss, because that's quite like, oh, I don't like it. Everyone's got an ego and they want to feel that, it will just break even and it will turn back around, and sometimes it doesn't, and over time that's eating away at your return in terms of the time function. Because remember, there are 3 inputs for strong returns. Input number 1 is time. Input number 2 is the amount of capital the investor starts with, and input number 3 is the rate of return. Those 3 are combined to give the total return over time. Now if time is working against you, that's going to lower your ultimate total return. So you have a situation where the investor is waiting for that break even. So that's one part of the problem. Not confronting the fact that, okay, I thought X, Y, and Z 2 years ago, and right now, 2 years forward, it doesn't really seem to be working out. Rather than waiting for break even, the investor will be much better off by just confronting reality. And that's what I do in my marketplace. I say, okay, I know that some people are really positive about this company, but I don't believe that it's really turning out to be the way that I originally thought so. And the quicker that a person is able to come up with a new hypothesis that they may not be right, the better. Furthermore, if even coming out at a loss, if that money is redistributed towards a better investment, that can actually make for a better gain, because a person doesn't have to make back the capital the same way that they lost it. And that's what a lot of gamblers do. They kind of double down and triple down on something that isn't really working out, and it's not necessarily the right strategy. So not willing to confront reality is really topic 1. Topic 2 is commitment and consistency bias. This is when the investor really falls in love with the company. They have really positive feelings towards the CEO. This right now is quite an easy thing to do, because with social media it's quite easy to follow and understand the mindset of the CEO. And I put understand in quotes because that is just a PR spin. A team works around the CEO to portray, to make the CEO live the image that they keep reiterating. But that's just rhetoric. There may be originally some grains of truth there, but it just becomes kind of magnified, the whole personality. So to combat this, what the investor should never do, it should never really become complacent. And often the investor becomes quite passionate and they talk about the stock to everyone, and every time that they're talking about it, a person is becoming more and more entrenched into that company. Also, the investor needs to break away from the consistency. So our minds are predisposed to look for information that conforms with our preconceived notions about the company. We're scratching the surface and looking for things that align, make us feel good about our investment and why we are right. But ultimately, that may not lead towards a strong return. Just knowing so much about a company can actually detract, because a person becomes so entrenched in that company. A slightly better thing to do is to every so often just take a step back and see, okay, does the valuation still make sense? Is the company still trying to increase its earning power? Because sometimes there's a bit of a information distortion. We kind of looking for things that really make us feel good about that company, and that may not necessarily be a very wise investment strategy. Also, an investor, if the investor's been holding on to some gains for a few years, they have what Peter Lynch calls bragging rights. They have a double or free bag on the stock, and they feel so good they're no longer willing to question whether the valuation still makes sense. If the investor is not willing to buy the stock at that price on that day, it may be that someone else is not willing to buy, and to hope that the share price keeps going up just because the investor feels good about that company isn't necessarily a good investment strategy. The way I do it is, if I'm not willing to buy into that stock, I can't expect someone else to be willing to buy into that stock. It's like Seth Klarman talks about, leaving a little bit of food for the pigeons. You have to leave a little bit of upside. You have to leave the stock while the going is good. Because what is the worst thing for an investor is if the investor is holding on to some gains, they overstay their welcome and they round trip. Basically, the stock goes up significantly and comes back down, and you're back to square zero. So you not only feel, at that point you feel really negative, you're kind of like, you don't like the company. And if the person had just sold out at a high point, when the share price sells off, you might be willing very enthusiastically to come back into it, although the share price has just round tripped. But there's all that negative emotion towards it. So it's very important to break away from this commitment towards it, because here's the best rule: the stock doesn't know you own it. So if you've held the stock for a year, or you've held the stock for a day, the stock doesn't care. And if you're holding on to, let's say, large gains, it could be time to reassess, and not just to stay with the stock just because it seems to be working out. Because it may have been working out for a while, but then the valuation may have just taken away. So it's very important not to fall in love with the stock. So that's point 2. On to point 3. So a lot of times the company is a high quality company, and high quality companies don't really sell off very much. And investors sometimes say, oh, okay, I like company XYZ, but the price doesn't make sense to me right now, I'm going to wait for it to pull back. But high quality companies rarely go on sale, and when they do, it could be a very difficult time emotionally to get into the stock, because you keep price anchoring. You keep thinking in your mind, okay, the stock is at, let's say, $10, and now it's at $50, $100. Oh, I missed the boat. And that's just price anchoring. And that's why I very much do away with looking at a chart of the share price, because it just leads you to have an illusion of whether the company could be worth X, Y, and Z. But that's history, and it doesn't really help the investor today looking ahead. What matters to today's investor is the earnings power in the future. So the high quality company, if it goes on sale, it could be the case that the thesis is broken. That very sound business model has suddenly become disrupted, and at that point might not be a very good time. Remember Peter Lynch's quote that more money is being lost by waiting for the crash than from the crash itself. So it's very important to understand the business understand the peers, understand the landscape. It doesn't take too much work. A person can go through the 10K, 10Q, the earnings call. Within the 10K, just pay a little bit of attention to the top 3 risks. You can just look on the 10K risk factors. The top 3 really kind of cut through a lot of the noise. Try and understand that. Also, it's quite helpful, I believe, to understand who owns a stock. If the CEO is a CEO and a founder and he owns a significant amount of stock, his incentives is very much aligned with his little baby, his or hers. And that CEO can be very much more passionate, more driven towards leading to shareholder gains rather than the CEO that's probably, let's say, number 3 in a long list of conveyor belt CEOs. So by looking for high quality companies is the starting point. Looking at the fundamental business model is the starting point. The correct strategy is to think about the business and its earning powers into the future. It is not thinking, okay, this is not a good time to invest. It's always a good time to invest. Even in the market's going up, even the market's going down, it's about thinking about the best quality companies. And this is not necessarily just the FANGs, the Facebooks and Alphabets and Amazon, but it can be a small company that is doing terrific things. So look for a high quality company and don't think that their share price has gone up, so I've missed the boat. That is not the right way to go about it. Think deeply about the landscape and look at the margins of that company and its peers. If all the peers have got high margins, it could be a very attractive sector that is rapidly expanding. On the other hand, if that company and all its peers have got a continually contracting margins, it could be that the business is facing a very significant headwind, and it's very difficult to pick out the one company in a sector that's facing a significant headwind that's going to turn around. Remember what Warren Buffett says, that turnarounds seldom turn. So it's very, very difficult. It sounds very attractive to buy something that you're going to turn around, and then you buy it cheaply and it turns around and then everything is rosy and everyone's hunky-dory, but that's quite difficult to do. It's much better investing in a high quality company into an expanding market. And of course, right now in 2020, all investors are trying to do that. All investors are looking and scouring the market for new opportunities. And it's very competitive. So it's very important to understand the actual landscape and just understand the peer group. It doesn't take too much work. A person can just go through a few earning calls of the peers and compare and contrast. The example that I often give is that a person would not buy into a house and move in without knowing how the neighborhood looks. Just looking around at the prices that neighboring houses have gone. That gives you an understanding of the asset that the person is buying. So today we talked about 3 different things. We talked about looking for a thesis breaking moment, confronting reality. We talked about not falling in love with a company, trying to discern out the points that really make sense. Don't look at the stock and say, okay, the stock is I'm holding significant gains, thereby, I'm just going to wait it out, I'm just going to let it ride up, because it may not make sense. You, a person may have made significant gains over the last 3 or 4 years. It doesn't necessarily mean that the company is going to expand at the same rate over the next 2 or 3 years. It is important to let the winners go and to move out of losers. But that doesn't necessarily mean that if the company keeps going up and up and up, that the underlying business is still as rewarding today over the next 5 years, that the earning power is still going to go up. And point number 3, we talked about, is this a good time to invest? So a high quality company rarely goes on sale, and it often regularly carries high multiples. So I hope you found this video useful. Don't forget to check out my marketplace on Seeking Alpha. It's called Deep Value Returns. I'll tell you the stocks that I own and why, and I give you a hybrid portfolio so you can choose stocks that make sense to you. Don't forget to subscribe. I'll see you soon.